You're wasting 20 years of your life and you don't even know it. The average American loses 20 years of their life through taxes. What I'm going to show you next is how to take those 20 years back. The average person spends 20 years of their life working to pay taxes. Now, that doesn't mean that it's 20 years of working. It means that 20 years of their life is actually working to pay taxes. So it's not just money we're talking about when it comes to taxes, it's time. You know, money we can get back. We can make more of money. We can never make more of time. And so the time that you're wasting or giving to the government because you're working for taxes and not for yourself makes a huge difference in your life. Think about those 20 years you could devote to your family, to your friends, to your hobbies, to your lifestyle, to your business. So here's what I'm going to show you. I'm going to show you why it happens, 3 practical ways to buy back your time, and how the tax code actually wants you to pay less taxes, and only if you know how to use it. So in the US and most developed countries, in an 8-hour workday, you're spending 2 hours and 40 minutes just to pay tax. That's 4 months of every year that you're working for the government. Ultimately, that adds up to 20 years of your life. We call that a prison sentence. That's 20 years of vacations not taken, businesses not built, investments not made, and time with your family gone. We've all heard time is money, but the real truth is money is time. When you lose money to taxes, you're not just giving up dollars. You're giving up time that money could have given you back. That's why tax strategy isn't just about saving money. It's about buying back your time. Now, here's strategy number 1. Turn your everyday expenses into business deductions. Here's the difference between an employee and a business owner. An employee gets taxed on their gross income. That's income before any deductions. A business owner gets taxed on their net income. That's income after deductions. So the first thing that's important is you own a business. Now that business could be a real estate investment business. It could be a Airbnb business, VRBO, or any short-term rental business. It could be a restaurant. It could be an online business. All of these businesses qualify. There are everyday expenses, though, in these businesses that you get to legally deduct. Here's 5 that most people miss. Number 1, home office. I cannot tell you how many times I've been on stage and asked people how many were told not to take a deduction. And a good 60-70% of the people raise their hand. And I asked them, of those of you who raised your hands, how many of it was at a home office? And most of the hands stayed up. Now, here's the thing about home offices. Home offices are not just about deducting a portion of your home, which, by the way, and I go through this in my book, The Win-Win Wealth Strategy. Remember, you're spending this money anyway on your home. You're already spending money on the cost of the home, on the interest, on the taxes, on the upkeep, the repairs, the maintenance. You're spending all that money anyway. Why wouldn't you let the government pay for part of it? I think it's crazy that people don't take home office deductions. And why don't they take them? Because some uninformed accountant or tax preparer said, well, that's a red flag for the IRS. Do you know it's only a red flag for the IRS if you're a sole proprietor? If you actually are an S corporation or a partnership, it's not a red flag at all. In fact, there's nowhere to report that you have a home office. So you've got to follow the rules. The home office, the rules are really specific, okay? And watch for a separate video where we talk just about home office. But here's the other thing. If you have a home office, remember that a home office actually increases your automobile deduction. Well, why is that? Well, because remember that the first trip you take during the day is a commute and it's non-deductible. And the last trip you take during the day coming back to your home is also a commute, non-deductible. Well, what if your commute were the 30 feet from your kitchen to your home office at the first of your day, and then you take your second trip out to see your rental property, to see a client, or to go to your business office where you're meeting with clients or employees. And then your last trip of the day isn't the one where you come home, because what you're doing is you're not coming home. You're coming to your prime principal office, which is in your home. And then your commute is the 30 feet from your home office back to your kitchen. All right. And by the way, can you have both a home office and an office outside the home? The answer is unequivocally yes. There are specific rules on how to do that. Watch for my video on home office. I'll walk you through all of those specifics. Home office, number one. Number two, business travel. We've done an entire video on business travel. Don't forget that business travel is deductible if you meet the test for deducting it. Third is car expenses. This is where you can use, the mileage rate. And if you travel a lot of miles, business miles, probably the mileage rate's the best bet. 70% a mile right now. That's a big deduction, right? If you're traveling 30,000 miles a year, that's a $21,000 deduction. So that can be a pretty big deduction if you're traveling a lot of miles. Or you can do actual expenses, which if you travel very little like I do, I actually do most of my work in my home office. I travel from my home office to my studio where I am now, and that's about 30 feet. And so if you don't do a lot, then actual expenses is better. Business meals. Business meals are one of the most missed tax benefits of being in business. Why? Because we think it's only with business colleagues. What about when you take your spouse or your personal partner to dinner? If you're a business owner, I'll wager $100 that if you're a business owner and you take your spouse to dinner, you are talking about business at dinner. Now, not if you go every night, but remember, it's got to be ordinary and necessary. But if you take your spouse to dinner, say once a week, you're probably going to talk about business with your spouse. As long as you do and you document it properly, then it's going to be deductible. Finally, education. You get coaching. You hire a good CPA, do a tax strategy or a wealth strategy. You take courses for your business, all deductible. Now, I would suggest calling it continuing education, because the IRS is less likely to audit continuing education than if you call it a seminar. Just a little trick there. Okay, now here's how to do it right. First of all, you start an LLC, limited liability company. It's your side hustle. Okay, that's fine. Open a business bank account. You must have a business bank account, and you have to track everything with apps like MileIQ or Keeper Tax. There are all sorts of apps that you can use to track your business time. Okay, and what you're doing, your business expenses. So make sure you track everything. Also, make sure you keep corporate records like annual minutes. And if you're doing something big, like you're doing a big 2-week travel and it's going to be business, document that in minutes, right? So because you want to look big, even though you're actually small. So look like you're big and do the things that the big companies would do. Remember, the IRS isn't your enemy. They actually want you to do these things as long as you do them the way they want you to do them. So strategy number 2, earn like an investor, not an employee. Remember, the highest tax income is earned income. Earned income means that you're paying ordinary income tax at the highest rates and you're paying Social Security tax. That's earned income. That's like a W-2. Now, then there's a type of income called portfolio or investment income, which is like dividend income or capital gains, which is taxed as low as 0 up to 20 or as high as 23.8%. Then there's passive income. Passive income is not like interest income. It's not like interest on a bond. Passive income under the tax law means that there's a business that you're invested in. It's a pass-through business like an S corporation or a partnership, and you're an owner in it, but you don't actually work in it. Passive. Now, here's why passive income is so important, because it's really easy to get passive deductions on things like real estate investment. So you want to be able to offset your income with those passive deductions, but passive deductions can only offset passive income. So you need passive income. You need passive income. So make sure that you're structuring your investments. And why does the government do this? Because what does the government want you to do? They want you to invest in things like real estate, business, agriculture, and energy. And those you're going to tend to invest in passively. Now, not your own business, that's going to be active, but somebody else's business. They'd like you to be that angel investor. They'd like you to help build that next great thing, okay? Whether it's AI or something else. You can actually get to 0 tax on passive income pretty easily with a good tax strategy. Now, let me show you how this works. If you flip a property, let's say you're in real estate. I'm going to go flip properties. That's earned income. Well, now I'm going to change it from earned income to ordinary income. How do I do that? I just do my flipping inside an S corporation. Now, all of a sudden, I'm not paying Social Security tax on 100% of my income. I'm only paid on the salary that I'm getting out of the S corporation. I can flip a property, but I flip those properties inside an S corporation. I don't do it in an LLC taxed as a partnership or a sole proprietorship. It's very important. LLC, if it's great to be an LLC, but taxed as an S corporation if you don't want to pay Social Security taxes. Now, let's say instead, I don't flip it. So I'm not going to put this one in an S corporation. I'm going to put this one in an LLC that's taxed as a partnership. I'm going to hold it for a year. I'm going to get rental income. That rental income is going to be passive. Now, when I sell it after a year and a day, it's going to be long-term capital gain. So it's going to be portfolio income taxed at that 0 to 20% or most at 23.8%. Okay. So I can even go one step better, which is when I sell it, I can do a 1031 exchange and not pay tax at all. So I can take it to 0. So I'm just converting my income from a high tax income, earned income, to a low tax or no tax income like passive income or a 1031 exchange. That's a conversion strategy. So remember, if you're going to be an S corporation, make sure you pay yourself a reasonable salary and make sure you combine it and optimize that salary so that you're also optimizing your qualified business income deduction, that 20%, soon to be 23% additional deduction that business owners get. Take the rest of the distributions, don't pay Social Security tax. That can save you 15% right off the top. Now, over 95% of the Internal Revenue Code is not about collecting taxes. It's actually a roadmap for reducing taxes. It's about giving you incentives to do things the government wants you to do. Here's 5 places the government will reward you. First, business, okay? Business is number 1, always number 1. By the way, that's true in the US and all over the world. Number 2, real estate. Number 3, oil and gas. Number 4, renewable energy. And number 5, agriculture. Now, if you like agriculture, I would actually put that back up as number 1 because agriculture actually has more tax benefits than any other classification of business, right? But remember, these are all businesses: real estate, oil and gas, renewable energy, agriculture, any other business. Job creation. That's why the government is incentivizing. They want food production, they want energy production, they want job production, and they want housing built. So that's why the government does this. These are not loopholes. When you hear loophole, run away, please. If loopholes are things that are mistakes in the law. And are there loopholes? Yes. Okay. Will we take advantage of a loophole on occasion? Sure. But why use a loophole that the IRS may challenge when you can use an incentive that the IRS is never going to challenge because it's exactly what the government wants you to do in the first place. And you document it. You're on all fours, as we call it in the tax profession, meaning that you are squarely within the law. Why take a risk when you don't have to? You can reduce your taxes as low as 0 if you do what the government wants you to do. Now, what do you do right now? Get started. That's the first thing to do. Get some education and then start a business, start a side hustle, buy a franchise. Okay, invest in a franchise, another great way, or multi-level marketing. Okay, these are easy small businesses to start. Start with a business online. Okay, say an Amazon type business, right? Start a business. You've got to have a business first. Next, track your expenses. Make sure you're doing good bookkeeping, whether you're using QuickBooks, Xero, some other general ledger software, or, make sure you do like KeeperTax, MyLife, keep track of things. Use a spreadsheet if you need to. Just use an Excel spreadsheet. You're fine. Keep track of it. Save your receipts. Now, when you save your receipts, don't save the physical receipt, okay? Put your notations on the receipt, who, what, when, where, and how, right? Put the notations, scan it, and keep the scanned copy. The paper will fade. So you don't want to keep paper, keep a scanned copy. Meet with a real tax advisor in the early part of the year, not just at the end of the year or on April 15th, please. Tax deductions happen every day. Tax planning happens every day. Tax returns happen once a year. So if all you want is tax returns, you're going to meet with the tax preparer once a year. If you want tax planning, you're going to meet with your tax advisor on a regular basis, preferably monthly, but no less than quarterly. Very important. And if you're getting pushback on these things from your tax advisor, maybe you need to upgrade your tax advisor. Maybe you need somebody who actually has read tax-free wealth, who subscribes to the ideals of tax-free wealth, that look, the tax law is a series of incentives. It's not, the IRS isn't just out to get you. Now, here's a bonus tip for you. Audit-proof your life. If you're worried about an IRS audit, I want you to write this down. I will never speak to the IRS. I will never speak to the IRS. That is not your job. That is my job. My job as a tax advisor is to speak to the IRS on your behalf. So don't ever speak to the IRS. Second of all, document, document, document. You've got to keep good documentation, okay? That means that if you have a business meeting, at a minimum, keep a calendar, right? Make notes, right? Who's the lunch with? You know, why did I take this trip? Just take 30 seconds, an hour, or 30 seconds every time. Just keep good records. And then what's going to happen is if you do get an IRS audit, you're just going to hand those records over to the IRS and they're going to be fine. They're not going to complain. I represented somebody once, not a client of mine. She only became a client because she wanted me to help her with her IRS audit. Probably a mistake on my part, because the IRS auditor said, hey, there's no documentation here. There's nothing that suggests why this is business. Okay, so you got to keep the receipts. You got to document it. Okay, so look, taxes may be our biggest expense, also our most controllable expense. If you're paying high taxes, it's because you choose to pay high taxes. I know that's an uncomfortable thing but the reality is you're choosing not to learn about how to reduce your taxes. You're choosing not to have a good tax advisor. You're choosing, let's say, for example, take that business travel. You choose to take a vacation and not do any business. That is okay to choose that. It's okay to take a vacation, but you are choosing whether you pay tax or not on that business trip, whether you get a deduction or not. I make that choice all the time, but I know it's a choice. I am making the choice because I am well-versed in the tax law. I pay attention every single day. I pay attention to what credit card I use. I pay attention to how I document things. And when you do that, more and more of your daily expenses become deductible, which means less and less of your daily income becomes taxable. So let me ask you again, what would you do with an extra 20 years in your life? You know, longevity, I was just at a longevity conference. I saw an article in the Wall Street Journal just the other day on this. It's a big deal. People want to live 10 years longer. What if you could live 20 years longer without living a day longer? Get 20 years back without living a day longer. 20 years back of your life because you're doing what the government wants you to do, the way they want you to do it. You're following the rules, you're following the guidelines, but here's what you're doing. You're thinking about taxes every day of your life, not in a bad way, but in a, hey, I can make this deductible. Hey, I can make this non-taxable. Hey, I could pay less tax on this. And therefore, I end up paying far less taxes. I make way more money, pay way less tax, and get 20 years back in my life. It's possible. We do it every day. Most people will never take the time to reduce their taxes because they don't know how. I'm going to make it easy for you. I've made a one-page cheat sheet that will help you on a daily basis reduce your taxes, pay less tax, make more money, and get your life back. Download my cheat sheet by clicking on this link below. You probably didn't know you can write off your family vacation, make it a tax deduction. I'm going to show you exactly how to do that in this next video.